A warm welcome to you, my dear children. We meet once again with the latter part or the next chapter of Unit 8, Cash Book and Petty Cash Book. Well, we have come quite a way up to this point. Today we are going to learn how to record transactions in the cash book. We are going to learn how to record transactions in the cash book. Right. Let's get to it without further delays. It says cash is an asset. Cash is an asset of the business. The receipt of cash increases assets and the payment of cash decreases assets. Do you agree? Tell me. Do you agree? Do you agree with this? Yes, of course. Of course. No doubt about that. Cash is an asset. Cash is an asset. Yeah. When we receive cash, when we get cash, our cash asset increases. It goes up, 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 up. But we like it when we get more cash, right? We don't get cash, the business gets cash. Well, anyhow, when we get cash, when the business gets cash, cash asset goes up. When we make payments, when the business incurs expenses like rent expense, electricity, water bills, transport expenses, advertising, insurance, expenses. We have to pay for expenses. Likewise, when expenses incur, our cash asset, no, it doesn't go up. Our cash asset goes down, 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 down. Yeah. Well, too bad. Even though we don't like it, we have to pay the expenses. We have to pay for the expenses. So when we pay for expenses, cash asset goes down, 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 down. But when we receive cash, cash asset goes up. Okay. Considering that cash coming in and cash going out, we record the transactions in the cash book. Considering the cash receiving and paying, we record. That's the base we use to record in the cash book. So, as it says here, the receipt of cash increases assets and paying of cash decreases assets. Therefore, the double entry principle for assets, should be applied when recording transactions in the cash book. Alright, we'll apply the double entry principle for assets. Before applying, you should know the double entry principle, right? Yeah. This is the rule. What is the rule? What is the double entry rule? The rule of the principle of assets. The double entry principle of assets. Tell me now. You tell me. What is the double entry principle for assets? Tell me. You can't say that I can't remember. You can't say I don't remember. You must memorize the double entry principle. The double entry principle, the double entry rule is a must. Without that in your heads, you can't do accounting. Without that, you can't do accounting. Yeah? Alright. I'll just tell you the double entry principle for assets. Asset increase, debit, asset decrease, credit. Repeat with me. Asset increase, debit, asset decrease, credit. Increase debit, decrease credit. Okay. All right. That is what we are going to apply. So when cash is received, our asset increases, then it's a debit. All right. When cash is paid, our asset decreases. When cash is paid, our asset decreases. It's a credit. Payment is a credit in the cash book. When we pay cash, those payments are credited to the cash book because the rule decreasing of assets is always credit. But when we receive cash, cash book is debited because of the rule asset increasing are debited. Okay, tell me whether you got this or not. Well, there's nothing for you to realize it. There's nothing for you to understand. It's just memorizing. Okay? It's just a matter of memorizing. What is the double entry rule of assets? The double entry principle for assets. Increasing debit, decreasing credit. That is what they have mentioned here. That is what we have highlighted here. Cash receivings means it's an asset increase, so it's a debit. Cash payments means it is an asset decrease, then it is a credit. Cash book should be credited. Okay, right. So accordingly, all the cash receipts should be debited and cash payments should be credited in the cash book. Okay. I'll ask you a question. I would like to know, children, I would like to know from you. Why are we talking about debits and credits in the cash book? Why are we talking about debits and credits? Likewise, why are we talking about debits and credits? We talk about debits and credits when we talk about ledger accounts. So what? This is a ledger account. Cash book is a ledger account. Well, we learned about this. I told you this. Cash book has a dual role. First, it is a prime book. Again, it is a ledger account too. First, it is a prime book and it is a ledger account too. That is why we have to talk about. That is why we have to talk about debits and credits. Okay, here we go. Since the cash book functions as a ledger account, when the business receives cash, debit entry of the double entry is entered in the cash book. Only the credit entry of the relevant account, only the credit entry of the transaction has to be posted into the relevant ledger account. Well, I remember saying something like this in the previous session. I told you this, children. I told you. In other prime books, when the transactions are recorded in other prime books, okay, the transaction is recorded then and there when the transactions occur, right? And then that transaction is transferred to the ledger as a double entry. But in cash book, no double entries. I mean, there is a double entry, but one entry is in the cash book itself because it is a ledger account. Only the other entry goes to the relevant ledger, relevant other ledger account. If the cash book is debit, that is one entry because cash book is a ledger account. The credit entry only should be entered by you to the other account. Okay, debit, credit. Even now, if you don't understand, you're going to understand when you prepare the cash book. Here, you will understand. So no worries. Okay. Only the credit entry of the relevant account. Yeah, only the credit entry of the relevant transaction to be posted to the relevant ledger account. Since the cash book functions as a ledger account, when the business receives cash, debit entry of the double entry for that transaction is entered in the cash book. Only the credit entry of the relevant transaction to be posted in the relevant ledger. Similarly, vice versa. Okay. The values that are debited in the cash book should be credited to the relevant ledger account. I mean, when an amount is debited to the cash book, that is definitely, if it is a debit, that is definitely a cash receipt. So when we receive cash, it's debited to the cash book. Okay, it's debited to the cash book, and the same amount should be credited to the relevant ledger account. Then the double entry is complete. That is what they say here. Okay. When a value is debited to the cash book, it should be credited to the relevant ledger account. When a value is credited to the cash book, it should be debited to the relevant account. Double entries. Done. Let's go and prepare one cash book, shall we? That's the best thing. That's the best thing we can do right now. You're going to understand when we start to record. Just hang around, pay attention, watch and learn. Following transactions in cash took place during the month of January. Following transactions in cash. If the transactions have occurred in cash, which means if the transactions are cash transactions, we have to record them in the cash book for the month of January. In Lakshmi's business, Lakshmi, oh, it's a nice name, Lakshmi's business, yeah, which was commenced on 1st January. Okay. Right, here you go. We have some transactions, children. We have some transactions right here. Month of January, right? For the month of January, from 1st January, can you see? From 1st January, see? From 1st January, receipt number 1, which means 1st January, we have received cash, and the receipt is number 1. That is the first transaction. First cash received. First receiving of cash under the receipt number 1. Okay. And the transaction is what? Oh, capital invested. Lakshmi has invested capital rupees 80,000. Capital invested rupees 80,000. Okay. Okay. That is the start of the business. How can we record this, children, in the cash book? Well, it is a cash receiving. It is a cash receiving. We get cash from the owner. We get cash from the owner. Cash money. This money is put in the cash register or the cash till. That's it. So it's a cash income. It's a cash inflow. Cash in or cash receiving, which makes the business cash increase. It will increase the business cash. Asset increase, debit. Got it? Debit. But that's the first entry, the debit entry. What about the second entry, the double entry? What have I told you? What have I told you about designing the double entries? Children, I have told you when making double entries to follow the in and out approach. In and out. Or the increase and decrease approach. I have told you, right? Yes. Yes, I have told you. Always remember the double entry principle. Without the double entry principle, you can't do accounting. All right. So let's first remind ourselves the double entry principle. Right? Okay. Double entry principle. Here we go. Double entry principle. Double entry principle. Okay. Assets and expenses together. Assets and expenses together. Assets and expenses together. Okay. Liabilities. Capital. And incomes together. Liabilities, capital and incomes together. That's right. We'll use the increase-decrease approach, huh? Increase and decrease. Now you tell me. Now it's your turn. Now you tell. If assets increase, if assets increase, if assets increase, debit or credit? Assets and expenses, let's take both of them together. If assets and expenses increase, debit or credit? Debit or credit? Increase. Debit. That's right. Debit. DR. Always remember that assets and expenses go together. Okay. Liabilities, capital and incomes go together. Then assets and expenses increase debit. If increases are always debited, decreases are obviously credited. Yeah, that's how it is. Increases are debited, assets and expenses, decreases are credited. Asset, decrease, credit. Okay? Yeah. Now we'll move down to liabilities. Liabilities. Liabilities, capital and incomes. Increases. Increases. Liabilities, capital and incomes. Increases. Increases. When liabilities increase, when capital increase, credited is the opposite of assets. Credited. Then is it too big? Okay. Then decreases are obviously debited. Will you be able to remember this? What was that? No. Then you can't do accounting. Simple as that. Alright, children? You can't do accounting. You must memorize this. There is no other way. Children, memorize this. It's about the accurate and correct preparing or making of any accounting entry. It is about the correct correct entries of any transaction. It entirely depends on this, right? So assets and expenses always debited. Debit increase, credit decrease. The other three, liabilities and capital and incomes, credit increase and debit decrease. Right. With that reminder, we can move on to our question. Right. Here we go. First transaction, capital invested 80,000. Capital invested 80,000. Capital means owner bringing in cash money. Owner bringing in more and more cash to the business. That means for the business, it's a cash increase. Cash increase, always debit. Increases, debit. Right? Then what is decreasing? Cash? No, cash increased. Cash came into the business. What is decreasing? Capital? No. when the owner brings in cash or other assets, whatever the owner brings in should be added to capital. So there is no decreasing there. Cash increases as well as capital increases. Both increases, cash and capital. Capital of the owner. That means owner's equity, because the money is owner's money. When he puts in more and more, his equity increases in the business. Cash increases, capital increases. Both increases. When cash increases, debit. When capital increases, what? Credit. Capital increases, credit. All right. We got the double entry, right? We got the double entry. Yes, we got the double entry. It's correct. Cash debit, capital credit. Okay, let's go and see. Here we go, children. This is the format of the cash book. This is the format of the cash book. Just like I told you, when we draw accounts, ledger accounts, first we draw the T. First we draw the T format. Then it becomes easier to draw the columns. First we draw the T format. Can you see the T format? Yeah? This is the T format. Okay. Then we divide the columns, children. We divide the columns the same way that you ruled the ledger account. Date. There is an additional column for receipt number. Description. Ledger folio and amount. Credit side, date. There is an additional column for voucher number. Voucher number. Description. Ledger folio. Amount. There you go. This is the format of a cash book. It's not here that we are gonna learn to draw the cash book. It's just an example to show the recording of transactions. The next exercise, the next activity, we are going to learn to draw the cash book in a easy way. Okay, in a simple and easy manner, we will learn to draw the cash book. Well, there's nothing much there. There's nothing much to learn. This is the cash book, but I'll just tell you how to memorize the columns. Okay, debit side and credit side. Debit in the left, credit in the right. Debit left, credit right. All right, let's check whether that double entry is correct. This double entry, capital invested 80,000. We said the double entry is cash debit, capital credit. Let's see. Cash book is debited 1st January. Receipt number 1. All right. Description is capital 80,000. So cash book is debited. Right. Cash book is debited. That's fine. That's correct. There you go. Then let's find the other account. What is the other account? What is the other account? Cash debit, capital credit. So the capital account should be there. Where is the capital account? Oh, it's here. So it's right beneath. It's right under the cash book. And in the capital account, it is credited. See, it is credited. 1st January, description is cash 80,000. Did you notice the double entry? Yes or no? See, children, this is the double entry, huh? That's it. Cash book, debit 80,000. Capital account, credit 80,000. It's simple or not? Very simple. Very simple. Let's take the next transaction. Second, it's not a receipt, it's a payment. So now we have a payment. Because vouchers are issued for payments. Bought goods for resale. Bought goods for resale. It's something that any business, any trading business does every day. They are buying goods from the suppliers. They buy goods, and for that we have to pay money. Cash goes out. Let's take the in and out approach. Ins are debited, outs are credited. What is coming in? No, not cash. Not cash. What is coming in? Goods coming in. We purchase, we buy goods. So a stock, boxes, or sacks, or whatever. Let's say we bought goods from Unilever, or let's say from Munchie, whatever the supplier is, whoever the supplier is. 10 boxes of biscuits. Okay. Purchase goods, that means goods came in. So goods ins are debited. Paid for the goods, that means cash out. Outs are credited. What should be credited? Cash. It says really clearly here, bought goods for resale 45,000, and it is a cash transaction. See, all the transactions are in cash. Cash going out, which means the cash book should be credited. Let's find that entry, cash book. Here you go. 2nd January. Voucher number is correct. Purchases 45,000. Yeah. Cash book is credited. Yeah, all right. Just wanted to show you that it is credited. When the cash book is credited, what should be debited? What should be debited? Which account, in which account this 45,000 should be debited? Goods account. Is it the goods account? Tell me. I told you that this transaction means it's a purchase of goods. So goods come into the business. Ins are debited, which means the goods should be debited. Goods account. 45,000 in goods account? No. We don't use a goods account. I very clearly explained in the previous lesson For purchasing of goods, we do not draw a goods account. We draw an account called purchases. Some children remember it as purchase goods account. If you want, you can say purchase goods account, but it's not the goods account. It's not the goods account. Draw the purchases account. Then goods come in, goods should be debited. No, purchases should be debited. Yeah. Let's find the purchases account. Where is the purchase? Yeah, it's debited. Correctly guessed, right? We guessed correctly, right? 2nd January, description is cash and it is debited with 45,000. Can you see it better now? 2nd January, cash 45,000 debited. So children, where the double entry? Here. Double entry is here. Cash book credit saying purchases description purchases purchases account debit description cash. Clear, right? All right. Next transaction. 4th. It's a receipt number, which means it's a cash receiving. And it says obtain a bank loan. Obtain a bank loan. Bank loan. Bank loan means we are borrowing money from the bank. Let's say 50 lakhs. Is it too much? All right. 1 million. Oh no, it's 50,000. It's a small loan, 50,000. Let's say 50,000 borrowed from the bank. What does it mean? Cash comes in, right? Cash comes in. Ins are always debited. Ins are always debited. Cash increase, cash in, debited. And what is the other entry? It's a liability. Taking a bank loan means it's a liability. Cash increases, at the same time liability increases. And we know that when cash increases debit but liability increases credit. Fine. So we are done with that. Now the double entry is clear to us, right? It's clear to you, right? Of course. Cash debit here, cash book debit, description bank loan, $50,000, and there should be a bank loan account. Let's see. Bank loan, oh, it's there. Bank loan account, credit, description, cash, 50,000. So, likewise, children, debits and credits in the cash book, recording of transactions as double entries using the double entry principle in the cash book. All right. This exercise is the exercise which is in your textbook. It is the example exercise which is in your textbook. With our next session, we are going to start an activity or an exercise and do it. You are going to do it with me, right? In addition to that, you are going to learn how to record discounts, what discounts are, and how to record discounts in the cash book. Alright, I'm highly expecting that you are going to get together in the next session too, because to finish this off, the recording of transactions in the cash book, you must learn how to record with discounts, how to record transactions with discounts. So children, thank you for being with me. I hope to see you soon with the next session. We are going to finish off the cash book part of this lesson. Thank you very much. See you soon.